Where is the recession? Will we have a recession? Is it a rolling recession, a white collar recession? Just what the heck is going on? And yes, folks, we're going to talk with Taylor from Life Goal Investments, but unfortunately we are having camera problems, but we still got audio. So here we go. How you doing, Taylor?
I'm doing great. Thanks so much for having me. You guys are all better off not seeing my ugly mug anyway.
That is hilarious. We're just going to keep it rocking and rolling. I guess the big question, Taylor, for you is right off the gate. Where's this recession? Everybody's been calling for it. I think you and I have called for it at different times this year. Where the heck is it?
It's funny. It certainly has not presented itself, and it really doesn't matter what you look at from an economic standpoint. Everything seems to be pointing in a relatively positive direction. We just got GDP last month or last week for the prior quarter, and the numbers look like the economy is still chugging along really well. Unemployment is still pinned beneath the water,
Mm-hmm.
really, really low. You look at everything, even when it comes to things like credit spreads, and that's usually an area that forecasts, things coming down the pike. They're really, really low, meaning people aren't forcing, borrowers, being companies, to
Mm-hmm.
pay high prices in order to take on debt. So it's funny. Everywhere you look right now, there doesn't seem to be signs of cracks forming yet.
Yeah. And I don't know if you saw it. I just saw it this morning. The first Q3 GDP forecast is something like 1.7%. So cooling from last quarter, but frankly, 1.7 is probably trend for the last several decades. So not happening in Q3 either.
No, yeah, it doesn't seem to be. And you know what? I know there are more Powell haters than there are lovers.
Yep.
And he got off to a bad note, right? He stuck with low interest rates too long as inflation got a hold of us. He continued to buy mortgage-backed securities in the market via quantitative easing for too long. He used transitory too much. I get
Mm-hmm.
all of that. But nonetheless, they've raised interest rates 5.5% in the last 18 months. And look at it, the economy still seems to be chugging.
Yeah, and I don't know if you saw, but I think it was Goldman Sachs. It might have been 2 weeks ago. Actually, lowered their odds of a recession at all. So I mean, we could seriously not even be talking about a soft landing. We with this dreaded no landing, may be where it's at. Goldman went from I think it was 30 to 20% or 25 to 20% or something. So even the big boys on Wall Street are like, I don't know, maybe it's not coming.
Yeah, it's funny. And when you think about your general kind of middle class type American that owns a home,
Mhm.
and when with the ownership of a home being the largest debt thing that you have outstanding as your middle class American, you're really not that largely affected. You're not at all affected there because almost every mortgage is fixed rate. It's
Yeah.
where do the variable rates really hit you? If you carry credit card balances, they certainly hit you in that format.
Yep.
But unless you're going out and trying to take on debt to finance a new business or whatever it might be, there really doesn't have that much impact on your life, the movement in interest rates, which is what the Fed's causing by forcing things up. Now, on the other side of the business aisle, if you will, businesses that are trying to expand and grow certainly are affected by it, but the general American does not seem to have that much effect, and it's shown through with consumers continuing to spend money even through the face of 5.5% interest rates where they're 0% 18 months ago.
Yeah, I think when you look at that, there's a lot in that statement that we should peel back, and it's a deeper discussion, right? So, what is the most interest rate sensitive part of our economy? Housing. So again, all right, interest rates go up 550 basis points, housing is going to crash. Everybody says that statement, Taylor, and they think price.
Yep.
It has
Yep.
been wrong this entire time,
You've
right?
been
When
pounding the table on this, and you've been so
gosh,
right.
yeah, it's transactions. Even if you go
Correct.
to the next levered one, it's cars. I could be wrong, but most car loans are fixed for 5, 6, 7 years. So a
Correct.
lot of folks got into debt, right? So we have a ballooning debt, but a lot of the monthly spend is fixed and it
Yep.
won't go up, right? So again, it affects transactions, which again, everybody wanted it to be price and it was never coming. But now we have to talk about it's net new lending. And the beauty about housing that I don't think a lot of people understand is housing has already taken it on the chin. We've already gone down 40%. It's not going down another 40% from here, right? Could it go down 5%? Sure. But we've already had the crash, right? You can't squeeze the, juice out that much more. So again, I think housing actually starts to add positive to the GDP. Housing has been a negative drag on GDP, I think, for 4 quarters. It might be 5 quarters now, but it'll start being positive going
Yeah.
forward. And people just don't get that. So we may not have a recession, right? I think this idea of a rolling recession that we've talked about on my channel for about a year is starting to feel more and more right, right? Housing gets into a depression, it baselines, then it starts coming out. Manufacturing rolls in, comes out. Retail services, they're not clearly in it. Maybe they'll be in it later. But yeah, rolling recession's feeling good, which means we may never have negative GDP in the next 4 or 5 quarters.
Yeah, it's interesting because this week we also get what they refer to as the sluice report, which is where
Yes, it's
banks report their
today, I
lending.
think.
Yeah, today or tomorrow maybe. But
Oh,
yeah, today or tomorrow. And so but it's funny. Clearly Jerome Powell, and I don't know what reports he sees ahead of time and what he doesn't, but he clearly alluded to the fact that he's seen this one, and he says essentially this is showing tightening of credit, tightening of lending from banks out to corporations, to individuals, but he says it's what you expected. So it's not showing some, all of a sudden the noose is getting pulled on things and it's getting extremely tight overnight. We knew that with, increased regulation that's coming in the regional banks, which just got passed or enacted last week.
mhm.
We know that when the banks saw their meltdown that happened in March, they were going to tighten their belt some from that standpoint. So again, he said, listen, bank lending is coming in, it is being constrained, but he said at the pace you would expect it to.
Yeah, I think you're right. It is tomorrow. Yeah, I stand corrected. Yeah. Okay.
And the other thing is, it's funny when you look at earnings. So let's just touch on earnings because again,
Yeah.
I'm a market guy, and that all backs into the economy, et cetera. Earnings so we're halfway through, almost exactly 50% of the way through S&P 500 earnings thus far, and what you see is that 80% of companies have beaten earning expectations. So 80, that's above the long-term trend. The long-term trend is something like 74% of companies beat earnings. But to be very clear, the bar was extremely, extremely low. So when you look at earnings growth year over year right now, from what we've seen reported, it's negative 7.3%.
And
So
that'll be the
earnings have
third
contracted.
quarter in a row, right? Third quarter of a
Correct.
row and negative earnings.
Yeah, and if it does come in, so what they do is they blend who has reported and the expectation for who has not reported yet, and it's
Mm.
negative 7.3% year over year, which will be the worst quarter that we've seen since COVID. But again, the bar was set so darn low. Companies did a really good job of saying, "Listen, it's not going to be pretty." And analysts did a good job of saying, yeah, rightfully so, it's not going to be pretty. And now they're clearing that very low hurdle, and the momentum is behind the stock market behind it. So, I mean, all things right now, you have slowing inflation. That's the one that I think is kind of the outstanding question mark is, does inflation continue to slow? We know it
It's
gets harder from here via the
yeah.
base effect. I know you talk about this all the time. You hit the nail on the head there. But CPI this month is going to be a real test, which comes next week. If we get any
Mm.
positive month over month inflation, it will show a month over month increase in CPI, or
Correct.
I'm sorry, a year over year increase in CPI, which is something that people have to be expecting. But I don't think a tick back up in CPI is something that comes with warm fuzzy feeling.
No, I mean that's a big risk. I mean this month is the one I've been pointing at. This could be a problem. We could break trend. I think it might be 13 months in a row of negative, every month being lower. We could go up. I mean, it won't be up a lot. I mean, it could go from 3 to 3.1, maybe 3.2. Um, but I don't know that the market's set up for a bump in CPI headline. I don't think the
Right.
market's ready. Yeah.
Right. And it's interesting when you look at us here, obviously we're tightening, right? So you
Mhm.
have bonds rolling off our balance sheet, you have us raising rates. You had the same thing that happened in Europe last week. The ECB hiked rates. The Bank of Japan also tightened in their weird format of they usually have the 10-year pegged at zero, and now they've broadened out the band to let the 10-year float a little bit more. But essentially, they're saying we're going to be buying less bonds in the market, the Bank of Japan. So it's kind of this global tightening policy, but yet the economy and certainly here in the United States continues to chug along pretty well. But even the global economic backdrop isn't as dire as what people would have foreseen if they said, listen, every central bank is unanimously, and that's a stretch to say, but all central banks are going to raise rates and tighten policy at the same time.
Yeah, the last thing I want to bring up about earnings in this whole conversation of where's the recession is it's actually not earnings, it's revenue, right? When companies report, they're often
Sure.
talk about top line and bottom line. And again, the
Yep.
bottom line is, quote, beat the, very low expectations. But the more and more reports I see, revenue missed. And I always have this saying, being one of those accountants behind the scene, is you can manage earnings a little, but
Yep.
you can't fake revenue.
Yep.
So I think the fact that more and more companies are missing top line is truly telling, but nobody's talking about that.
Yeah, so top line, so blended top line, and the number of companies I don't know underperformed versus beat expectations, whatever it is. Blended top line earnings are positive just 0.1%.
Oh wow.
So sales have moved, essentially zero over the last year. And so what that means is, if you have sales that have essentially gone sideways over the last year and you have earnings coming down 7.3%, obviously that means input costs have gone up. And that shouldn't necessarily shock anyone with the inflationary numbers that we've seen. So everything from raw materials to workers have been, significantly more expensive over the last year. And that's obviously eating away at the bottom line of the companies.
Well, there, and we'll put a pin in this one now, but I mean that's a 0.1 nominal. If you go in and you adjust
Correct.
for inflation, it's negative.
Correct.
Yeah.
Correct. Well put. Well put.
Yeah.
Yes. Yeah. So again, when you adjust for whatever inflationary metric you want to stick on that over the last year, yes, sales have come down. And therefore, revenues have stayed flat on a nominal basis. You're 100% correct.
Yeah. So Taylor, do me a favor. Thank you for doing this without the video. I thought it was a great conversation. Audience, thanks for watching this. Taylor, where can people find you?
Yeah, find us on Instagram and on TikTok at Life Goal Investments.
Thank you,
Appreciate
buddy.
you, Michael.
Uh-huh.